Welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I will be your host here today for about the next 20 minutes or so on Options Guide TV. So the markets have, been hanging in there, I think is a good term, wanting to set new highs, and some of the indexes are, some of the stocks are. We had a big report in Netflix today, and the stock is up about 10%. But it had a huge rundown in the marketplace going into that earnings. So we're going to take a look at Netflix, and then it's going to be a while before the rest of the FANG stocks. Netflix is part of the FANG group, FAANG, Netflix, Alphabet, Google, Alphabet, and then Apple. And they're all going to be announcing around Halloween, actually. That week is when all the rest of those mega cap tech stocks, and then on the end, we have NVIDIA, which NVIDIA got a really big pop-up because of what happened in Taiwan Semiconductor, who is their main client, and they had a really good earnings report implying that NVIDIA is spending a lot of money with them. And that's straightforward. That stock took off. That elevated the whole market. But I still feel like with the VIX hanging around right now on an up day, we see the VIX trading right at 1833, still a little bit elevated, but it's down 78 cents on the day. And if I still think that will be the case, you have the seasonality of October, and then you also throw in the fact that there is a known event called the election on the 5th of November. And when that until that gets done, until that day is over with, I do anticipate that the VIX will just kind of hang around trying to figure out exactly what, there's just a little bit of nervousness in the market around that event. Okay, so we're going to be kind of short and sweet. We did a trade in Netflix, no harm done by the trade, but let's run to the Tradier Pro software. Okay, and let me get it all set up. If you have any questions, feel free to put them in the chat box. If you are on the Tradier YouTube channel, you can ask questions via the chat box if you are logged in. And then also, logged into YouTube. And if you're in the Tradier Hub, hub.tradier.com, you can also ask questions via that platform, and inside x.com. There is a way to ask questions via that platform too, because we are now streaming live in x.com under the Tradier profile and under my profile, which is at Brian Overby. Okay, so we're showing Netflix. Netflix is at $763. It's up $75 on the day. That translates to almost 10%. But if you look at the chart, which was very interesting in Netflix, and let me zoom it in a little bit here. Okay, so look at all the red candles, and I can try to do this. Let's do this. You got 1, 2, 3, 4, 5 down days that we had red candles, and we talked about this. We did an education piece on Wednesday because I was unavailable. And so we talked about putting this trade on Monday. And if you wanted to adjust the trade, I said I would do it a little bit closer to the date, but Netflix was the first mega cap tech stock. So ideally, right here, we, on the down end, we had the underlying stock close at like 868, 686. 686 is where it closed at. Right on the 20-day moving average. Never got down towards the 200, but we still got our ducks in a row. So it kind of provided some support right at that level. And then we saw the big gap up. So right now, obviously, it's going higher. The trade, as I set it up, is doing fine. But when we started on the Netflix trade on Monday, the underlying stock was at 716. So that was trading right up here, right in this range when we, right about there. Yeah. When we looked at doing the trade, and that would have been right on the 20-day moving average. Seems to have bounced a little bit off of the 50, but that's right about where we were when the underlying stock, when we placed this trade. We were able to get it done for a small net credit, and the trade that we put on and I'll run over to the trading tab to show you that, it's still got a chip in a chair. The market is up based off of that trade. And this isn't a bad spot to be, but you do need another couple percentage point increases before the end of the day for this to pay out. We were able to get it done for a net credit of 20 cents to the account. So that means that if the market stays where it's at, we're going to make 20 cents on this trade, per 1 by 2 by 1 butterfly that we put on. We did it as a skip strike butterfly. That means that we had an additional requirement. And I'm going to run to the playbook here in a little bit, and I'll kind of talk a little bit more just about the skip strike butterfly. But in our instance, if you were doing a standard butterfly, you would do the 780, the 800, and then the 820, and it would be done for a net debit to the account. You skip that strike. We had to go a little bit further. We went to the 845. A lot of times you look at the 840, but that wasn't enough of a credit. So we actually went a little bit further out. It made a $2,500 requirement when we did that. And the net credit to the account was 20 cents. Now, the market ran down. A lot of things would have been different, actually. We probably would have been, if you adjusted these strikes relative to where the stock was on Thursday before they announced, with we were looking at, I think we said the expected move was 56 when we did it. And it's obviously moved more than that. And we moved about 1 standard deviation away. So based off of yesterday's prices, if you did set up the Netflix trade and say you did your homework and waited to the earnings, this trade would have turned out right where it's at. Pretty nice. You had a 50, because we went about 1 standard deviation out of the money on that trade, and that's about what the underlying stock has done here at a 9% move. All right, so let's talk about the trade that we did place on Monday. So we need the stock to drift up towards the 780 level. If it gets anywhere near the 780 level, I'm going to want to get out of the trade. Right now, if you were to sell this, I would ignore these option contracts here. I'm not as worried about it getting to the 800 level. If it got there, oh well, that's not bad, right? But I do have to buy one of these back because I can't be naked an option contract. And the way that this is working is that the 780 is tied into the 800, and that's a long call spread. And then the 800 is tied to the 845, and that's a short call spread. So if I were to do this trade, I would sell the 780, close out one of the 800s, and then let the short spread ride. Now, you're going to have some capital in your account if you do that, but that's the way that I would approach it. Now, I need the underlying stock to come up to that level. If you were to just take the trade off because you have these option contracts trading for pennies and these ones trading for nickels, the way that you would do that is you would just come in and look at the 780 strike, and you would sell to close, which it won't allow me to do because it's a paper trade. And this would be a buy to close, and then this would be a sell to open. And at this point in time, you can add an additional 20 cents to your trade. So if you did it, it would be a net credit of 20 cents. And that's mainly because you can still sell this for something. There's no reason to even kind of mess with this one. Honestly, you could just leave that one out there. So buy this, close these. And in that instance, you are then bringing in another net credit of 20 cents to the account. And that would mean that we are up a total of 40 cents on the trade. Not too shabby. The requirement was $2,500 per 1 by 2 by 1 butterfly that you put on. And like I said, if you would have adjusted it, you'd probably be sitting right in the middle. If you would have brought these strikes down, because the underlying stock traded on the close was about 686 right on that day. So based off of that information, 70 points, we're up 70 from there. Yeah, we would have been really close to being towards our center strike by this point in time. I don't know if anybody did it. If you did that trade, if you did the adjustment and you looked at doing the trade, let me know. All right. So I have a comment, and this is from Anthony. Go ahead and put that one up. Do you ever feel comfortable entering a modified butterfly for a small debit instead of a small credit? Yes, Anthony, I definitely do. But in this instance, I like the modified butterfly a lot. And the modified means that instead of skipping a strike and going further out and paying less for your protection, it basically allowing yourself to do this for a net credit to the account, you are going shorter. So in our instance, a modified butterfly, if you're talking about 780, 800, the standard would be 820, 20 points wide. You would do the 815. And that means that if the market did take off, you would make, or the butterfly would be worth $5 if it was above 815. Now, you got to pay a net debit for it. Now, the biggest thing about that is that if the market goes the opposite direction, you're out. You're out whatever debit that you paid for this trade. In this instance, if the market would have went down 70 points, you still would have made your 20 cents. And the way that I approach a skip strike versus a modified butterfly is that it's an alternative to just a short spread, to just selling a short credit spread in Netflix around earnings. And what you're doing, in my mind, is you're actually embedding that short credit spread is paying for the butterfly and then bringing in a little bit better credit. Now, I did this on Monday. Numbers would have been a lot different if you would have done them on Thursday. And I didn't like the credit that we received. We received 20 cents. I would have liked to have gotten 40 or 50 cents. But right now we could close this out. So in general, Anthony, I really don't mind that. I don't mind doing that modified butterfly, but you got to be very bullish. And here's one of the things around earnings is that you never know, right? You never know. So when I'm doing the modified butterfly, like recently, I'd say the most successful one that we did was a VIX modified butterfly. And I had a view on what was going to happen in the VIX. In other words, we did one at the end of August and we did one at the end of September when the VIX was at the lower level. 1 second. When the VIX was below 20. And when that happened, the modified butterfly kind of makes me feel a little bit more comfortable because I did feel like the VIX was going to go up. I had an outlook of that. But the VIX is a very scary index and the market could take off. So, moral to my story is I'd be more apt to do a modified butterfly in a volatile index like the VIX when I have an outlook as to where it's going to go. On Netflix, I was feeling bullish in the underlying. We set up this trade, but it's an earnings report. And until you know the earnings report, you don't know if it's going to go up or down. And you just know that it's going to go somewhere, right? So the skip strike in this instance was a little bit more comfortable trade for me. I wasn't as worried about it, considering where the market's at and everything, doing a 2 standard deviation move to the upside. I wasn't as worried about that. But it is a concern because you do have a heck of a lot more risk with the skip strike butterfly. But I don't mind it. I don't mind modifying it, stopping short, allowing yourself to be profitable if the market did take off and skyrocket up above. Okay, so next week, as far as earnings are concerned, we don't have a lot of mega cap tech stocks. IBM is going to be announcing next week. We have Boeing, which is always an interesting one to listen to. And let me grab a few of the other ones that we have. 3M's going to be announcing. We have Coca-Cola, AT&T. They're announcing it on Wednesday, but not as much fun. And then we get into all the fun. Then we have Apple, we have Amazon, we have Alphabet. We have all those mega cap tech stocks that are going to be announcing the week of Halloween. So yeah, things are going to get interesting. I always think of that as the heart of the earnings, and this is where we end up with this trade. So if you have any more questions, please feel free to put them in the chat box. Now, one thing that is interesting with Netflix is if we even go out, let's put in, see how many days it will take. Well, it goes 1,600 days. All right. Here's where the last high was in Netflix, all the way back prior to 2021, before we had the big downturn in the marketplace, and then the market skyrocketing all the way back. And now Netflix is looking like just a momentum buy, in that you had implied volatility come off in Netflix, and everybody's always doubted them, right? They got snubbed by the Magnificent Seven, right? The FANGs was a popular underlying to trade, and then they came up in the Meg 7. They threw NVIDIA in, and they got rid of Netflix. And with that mentioned, Netflix has said, well, if you're going to do that, watch this, right? And the stock has just had a strong upward basis, volatile within the markets. Everybody's always worried about Netflix valuation. But man, that is a clear breakout. If we stay up above, where is that level, right? Well, let's zoom back in here. Right here, 733.74. If we close at this high today and give it another day, well, you might want to think about just getting long Netflix, maybe just buying a call. It's going to be fairly expensive because it's a fairly expensive underlying, but you could see it start going up towards that 800 level. I think that's where my next stopping point might be in Netflix, only because it's a nice big round number. That's where we were actually targeting here, and we kind of did that on purpose. That was the reason why I picked that middle strike, is usually the stock will stop at that level for a second. Not always, but they like the marketplace in general likes big round numbers. So I guess my attitude on this would be that I'd let it play out for the day. If we can still drift up towards the 780 strike, hats off, right? We could still sell this thing for close to $1 and bring in a dollar net credit to the account. There's still a chance of that happening. But you're talking about a big move, and it's already moved what was expected in the marketplace, about a 10% move. That's where, when we did the math on it on Monday, I think we were fairly close. I think we were 9%, and now we are trading 9.5%. So the expected move was right around 9%. Now we're looking at 9.5%. So I don't know if we can get up towards that level, but I don't mind that. All right. So heading into the election, expecting volatilities to stay a little bit high. If I was going to flip the script on this Netflix and not, actually, this is a great example, and we'll run to this, but this might be where I would want to do a modified butterfly, Anthony. Actually, now I have a view. We definitely had a breakout according to the charts. And if you wanted to do a modified butterfly on a $700 stock, I don't mind that. So let's set one up. And we're going to go out a little bit longer in time. The biggest thing about butterflies, and this is part of the reason why I love when a company announces earnings on a Thursday, and Amazon almost always does, because you do have that 0 DTE option. You got 1 day for that option contract to live on that Friday expiration date. So I prefer when a big company like this with a high price stock announces on a Thursday as opposed to a Monday of the week. And the biggest reason why is that the high price stock, the fact that this is a $760 stock, makes the options more expensive. And if you think of options as insurance contracts, that's where that comes from. You're going to pay more for a Bentley car insurance than you are going to pay for your Chevy Cavalier, right? Which is pulling that out of my college days. But with that said, that concept applies in the stock market too. So you pay more premium because you got a higher priced underlying. You pay more premium because there's a known event that's called earnings. And then all of that premium, all that juice that's in the option contract has to go away in one day. It's got one day to live. So that is much more interesting to me to try to craft a strategy around than opposed to doing it on a Monday where you're still going to be battling all those issues, because time decay is still going to hang around, and on a higher price stock, it's hard to get the values to come in, especially on a three-legged trade, to where you can get your max profitability. Okay, so with that said, I think I'm going to go out 14 days. I don't mind going out 21 days. I'd like to give it a little bit more time to play out. But if we're correct on our forecast, we need time decay to work for us. So this is where this is just a great example. I like the skip strike on that Friday, doing it for a net credit because I don't know what direction it's going to go. It announced earnings. It is obviously bullish at this point in time. And not only is it bullish, it has broken out to the upside. And it looks like it's going to stay broken out to the upside. So implied volatilities have started to come back down. We're seeing the IV still fairly elevated. Right now, this is trading at oh gosh, actually, it's dropped off quite a bit. They're saying historical vol is around 42 inside the Tradier Pro software. And IV on these option contracts has really dropped off down to around 27%. I actually like it to be a little bit higher, but we're going to be able to do an interesting trade. Let's center it right around that 800 level. Let's do, 20 points. Maybe we'll go a little closer. Let's see if we can get a 20-pointer off for a reasonable net. A reasonable net debit to the account. Okay, the market's at 760, so the expected move is about 30 points. That puts you at about 790. And I do like that 800 level. So here's where we go. So let's buy this one. 790. We will sell 2 of those. Oh, I got to get rid of these down here. All right, let's try that again. 770, we're going to buy that. 790, we'll sell 2. That's 20 points, and then we'll go 15 points, right? So 20 would be 810. We'll go 805, and we'll buy. Yeah, $3.72. I'm all right with that. 370, we'll call it 350. Let's make it 350 just to make the math fun. Yeah, I would leave it in there at 350 for a little bit. You got a lot of volatility going on, obviously. I don't mind this trade right now. So that's a great example. Now I'm bullish on it. Now I got a forecast. Now I don't mind doing the modified butterfly and stopping short on the standard butterfly. And this is going to be it. We're right at, I want to get that done for 350. I think I'm going to enter this one. Why not? It's the market goes down. It's easy to flip this script on this trade. And an adjustment would be that you could sell the 770 and just be short the call spread right around 790. So you sell the most expensive option contract, you buy one of these, and that just leaves you in a short spread. And I don't mind that. That would be a 15-point wide short spread. So if you make the adjustment, you got to have $1,500. You got to have that margin requirement to do that trade. And this is the way that I think I would trade Netflix after their good earnings report. And we'll officially make that the paper trade. So it's $350 per 1x2x1 butterfly that we put on. And we'll send this to the what if calculator because the profit and loss graph will be interesting. All right. So you're here. We still do need a decent move to get up to the 770 level. But that option contract, if you look at that's an expensive option, right? If you're looking here, that 770, you're paying $12. Well, we're only paying a third of that, and we still get a lot of the juice from the 770 to the 790. Now, you got 14 days to expiration, so if it hits it right away, if we are correct on our forecast and it makes that move to 790 right away, it will be. You got to realize that you're not going to. It's not going to be a home run. You're not going to knock it out of the park if that happens. you'd put it on for $3.50 and maybe sell it for $5. You're only going to $1.50 wouldn't be a bad trade if it happened right away. If it happens closer to expiration, well, then you would expect it to double. You'd be looking to get $7 or $8, which means you'd be closer to that November 1st expiration date if you did it. Still a lot of earnings coming. The last week in October, this week, October 25th, that week is the kickoff of the rest of the earnings for a lot of the mega cap techs. So the week following the 25th, this is a Friday, is going to be a real interesting one. But right now, I like this based off of what we're seeing on the chart. All right, let's see if we have any other questions. All right, do you ever do iron condors for earnings plays? JP, I really don't. Mainly because I want a little bit more predictability. If I'm looking at an iron condor, I have exposure, right? And I'm basically saying that the underlying stock is going to make less than the expected move. And I'm going to sell something. I'm going to go at least one standard deviation out of the money on both sides, on the put and the call side. But I'd rather do those trades when it's a more stable situation. In general, iron condors just make sense to me in indexes, in ETFs, SPY. If I like the, energy stocks at the XLE is another one that's just interesting. If you're trading something that has a little more, you want some volatility and some predictability, even though that's an oxymoron, and you're not going to get that. Some volatility, some predictability, but you're not going to get that around an earnings report. So I prefer to stay away from just short spreads where I can't adjust it. And the thing about the earnings report, like you look at Netflix just jumped today. Like there really wouldn't have been much protection on your short spread. You're way out of the money. You might have got lucky and kind of been okay, but you didn't have that ability to adjust the trade. And I don't like that as much when I'm naked, when I have that naked exposure like an iron condor. Well, and then JP comes back and says, well, one of the problems, go ahead, we put it up there, is you got to pick a direction. Yeah, that is true. But that's part of the reason why we're doing the fly, though, is that we're taking a shot, might make a little bit of money, and we're not looking to try to make a home run on the trade, but we're limiting our risk by doing that trade. And with a fly, and I've done them before around earnings and got lucky, and it stopped very close to that middle strike. So it's possible to get a home run, but you're limiting your risk when you're doing the trade. If anything, like you're talking about doing the short spreads or the iron condors, if I'm doing an iron condor, I would prefer to at least just go one side. You're getting so much premium from going one, either a short call spread or a short put spread. I think I would lean that way, and I'd be more apt to do it on the call side of things around earnings. Stocks have a tendency to go down faster than they have a tendency to go up usually around earnings. And not always the case, but I feel like out of all the years of trading, that is normally the case. So I'd be more apt to do just a short call spread instead of doing both sides on that trade. And yeah, you do have to pick a direction. That is an issue. All right. So we came up with a paper trade. I didn't necessarily know that I was going to have one this Friday, but I do like the way the chart looks in Netflix, and I don't mind this trade. Thank you for the question, Anthony. And there we have it. We're still hanging right at that 350 level. We'll be back Monday. We will look at an earnings trade. We'll do another earnings trade, and I'll try to get a little bit creative with the strategy that we'll look at, and we'll pick a good underlying to do it on. Like I said, next week is a little bit of the doldrums, and there's some interesting stocks, but not as much as the week after. Thanks for stopping in. We'll see you Monday at 11 a.m. Eastern time for the next edition of Options Guy TV. Follow me on Twitter. Handle is @BrianOverby. I actually got a new article in there. If you scroll back on VIX options, and decoding VIX options is actually what the title is. Thanks for stopping.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.